160.50. The Bank of Japan is about to hike interest rates to 1%, and yet the yen is getting crushed. That is not a mistake. That is the trade. I want you to look at this chart right now and ask yourself a simple question. If everyone knows the BOJ is turning hawkish, why is price ripping higher? The answer is going to hurt a lot of traders who are fading this move, and it's going to make a lot of money for those who understand what is really driving this market. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end, because I'm giving you 3 exact levels you can trade tomorrow, with stops, targets, and the invalidation that flips the entire structure. If you are holding short yen positions, you need to hear every word. All right, instant market verdict. The session bias across all time frames is trending. I'm talking strong buy, strong buy, strong buy, monthly, weekly, daily, 5-hour, 1-hour. This is not a market you want to stand in front of. The ADX is sitting at 39.7, well above the 25 threshold that says the trend is muscular. The CCI is at 118, still pointing higher. We are not overbought in a meaningful way. The bias is long, the bias is strong, and the bias stays long until we lose a very specific level. Write this number down. If we get a 4-hour candle close below 159.75, the entire trend structure resets. I'm not saying the move ends. I'm saying the structural integrity of the daily impulse fractures. Below 159.75, the conversation shifts from buy the dip to sell the rip. Until then, the trend is the only trade. Now, here's what the herd is doing. The herd sees the BOJ headlines and thinks, yen must strengthen. They're selling into this rally, building short positions, buying puts, and they are feeling smart. The problem is, the smart money knows the yield differential is the real engine, and that engine is still revving. The herd is positioned on the wrong side of a freight train. That creates a massive liquidity pool above 160.55. The market loves to hunt those stops. Keep that in your mind. It's the gasoline for the next move. Let's dive into the technicals, top down. We start with the weekly chart. The weekly trend is a strong buy, and price is trading well above every major moving average. The 200-week moving average is not even in the picture. It's way down there, acting like a distant memory. The 100-week is around 157.91, the 50-week at 158.85, the 20-week at 159.65. Price is above all of them, and they are all sloping upward. This is an alignment you see in runaway trends. Now shift to the daily. Daily trend strong buy. MACD on the daily is positive at 0.44, and the histogram is not contracting. There is no bearish divergence. RSI is at 64.99. For a strong trend market, RSI can stay elevated between 60 and 80 for weeks. Do not use overbought as a short signal here. That is a classic error. The daily moving averages tell the same story. The 200-day MA is at 156.11. That level is a floor, not a ceiling. The 100-day at 157.91, 50-day at 158.85, 20-day at 159.65. Every single one is sloping higher. Price is stretched, but stretching is a characteristic of a trend that wants to rip shorts apart. Now drop to the 4-hour chart. This is where the trade setups will crystallize. The 4-hour trend is also strong buy. All moving averages are stacked bullishly. The 20 MA on the 4-hour is around 159.65, acting as dynamic support. The 60 MA is just below that, the 200 MA a bit lower. On the 4-hour MACD, I want you to notice something critical. We do not have negative divergence. The MACD line is above the signal line, and the histogram just started poking its head back above zero after a shallow pullback. That is a reset, not a reversal. This is what most traders miss. They see a tiny pullback and call the top. But in a strong trend, a shallow flag that holds above the pivot, which by the way is 160.30, is a continuation pattern, not a topping pattern. The pivot point at 160.30 is today's bull-bear line. Above it, demand controls. Below it, and we might see a deeper purge. The support zone is tight. S1 is 160.15, S2 is 159.90, S3 is 159.75. Notice how close these levels are. That clustering means the market is coiled. A low ATR of 0.4464 also confirms compression. When you compress a spring this tight, the release is violent. Now the resistance structure. R1 comes in at 160.55. That is the first gate. R2 is 160.70, and R3 is 160.95. Above R3, there is not much technical resistance until we hit the psychological 162 area, which is also where the Bank of Japan drew the line with its last intervention. The 60-minute chart adds granularity. The 60-minute trend is strong buy, with the 5-period MA at 160.31 and the 10-period at 160.07. Price is pulling back slightly but holding above both. The stochastics are at 84.79, which is elevated, so a micro pullback is possible before the next leg. But Williams %R is at negative 1.69, deep in overbought territory on the very short term. That tells me we might get a tiny flush that reloads the longs. Here's what most traders miss. The true danger here is a false breakout above 160.55. If price pokes above, grabs the stops of early shorts, and then immediately reverses on a BOJ verbal intervention headline, you get a classic bull trap. The invalidation for the trap is a 4-hour close back below 159.75. If that happens, the melt-up narrative is dead, and we are looking at a sharp mean reversion to at least the 50-day at 158.85. That's the swing level that flips the script. Let's connect the fundamental driver and the cross-linkage. The core news is a Reuters poll saying the BOJ is set to raise the key rate to 1% in June and 1.25% by year-end. That sounds yen positive. So why is US dollar to Japanese yen rallying? Because the market is pricing the path, not the destination. A 1% rate in Japan is still absurdly low compared to the US federal funds rate. And the gap isn't closing fast enough. The yield spread between US 10-year notes and JGBs is the true engine. That spread is not collapsing. It's actually grinding wider in recent sessions as US yields find a bid on sticky inflation fears. Until that spread turns down meaningfully, the carry trade, borrow yen, buy dollars, remains the most profitable trade in the G10 space. The BOJ can't save the yen and JGBs forever. They are trapped. If they hike too aggressively, they implode the JGB market and crush the Japanese economy. If they hike too slowly, the yen keeps bleeding. That's the intervention ghost. The ghost is not a policy tool. It's a last resort that historically only slows the trend. It doesn't reverse it, unless it's coordinated and massive. So the directional lean for the next 1 to 2 weeks is higher, targeting 161.50 and possibly 162. But with extreme caution because the closer we get to 162, the higher the probability of a physical intervention event. The exact invalidation for the bullish bias is a daily close below 159.75. That would signal a sentiment shift, maybe driven by a surprise Fed dovish turn or a much larger than expected BOJ move. But until then, the path of least resistance is up. Let's also crosslink. Watch the S&P 500. US dollar to Japanese yen is positively correlated with risk appetite. If the S&P breaks to new highs, that fuels the melt-up. If equities roll over hard, the yen catches a safe haven bid and that could do what the BOJ cannot. I want your input now. Do you think the Ministry of Finance intervenes this week? Comment yes or no right now. I'm tracking consensus, and in tomorrow's video I'll share what the community thinks versus what the positioning data says. Most people skip this next section, and that's exactly where the money is made. Keep watching. I'm about to hand you 3 trade setups with exact triggers, stops, and targets. Do not just listen, screenshot the on-screen levels. Strategy 1, the sniper, conservative. We wait for the pullback. Given the stochastics and the Williams %R on the 60-minute chart showing a short-term overbought exhaustion, we anticipate a micro dip into the support cluster. Entry trigger, a 1-hour candle close above 160.15, confirming that the support held and the bounce is on. Stop loss goes at 159.85, just below S2 at 159.90, giving you a tight 30 pip risk from a 160.15 entry. The logic is simple. If the S2 support breaks, the structure gets messy, and we don't want to be in that trade. Take profit 1 is 160.55, the pivot resistance. That's 40 pips, a 1 to 1.3 risk reward. Take profit 2 is 160.95, R3, 480 pips, a 1 to 2.67 reward. Once TP1 is hit, move your stop to break-even and let the runner ride. This setup is void if a 4-hour candle closes below 159.75. That level is the floor at the sniper, conservative, entry, 160.15, 1H close above, stop loss, 159.85 take profit 1, 160.55 take profit 2, 160.95 risk, reward. 1:2.67 invalidation, void if 4H close below 159.75 strategy. 2. The active trader, standard. This one plays the breakout retest. We are looking for an initial break above 160.55, the R1, followed by a profit-taking pullback to the pivot at 160.30. Your entry condition, a 15-minute bullish close above 160.35, after the retest of the pivot zone holds. Stop loss goes at 160.00, below the psychological round number and beneath S1 at 160.15. That's a 35 pip risk from 160.35. The reasoning, if the breakout is real, the pivot should hold as new support. If it fails, you don't want to be long. Target 1 is 160.95, the R3, 460 pips, roughly 1 to 1.7 reward. Target 2 is 161.20, a level just beyond the visible resistance cluster where stops from earlier short sellers sit. Once target 1 is hit, apply a trailing stop of 20 pips. Never let a winner turn into a loser. This strategy catches the trend continuation with a confirmation mechanism. Type your US dollar to Japanese yen range for tomorrow in the comments now. Let's see who's aligned. I want to see if the community is thinking range or trend. The active trader, standard, entry, 160.35, 15M close above after pivot hold, stop loss, 160.00 take profit 1, 160.95 take profit 2, 161.20 risk, reward, 1:1.7 R to TP1, 1:2.4 R to TP2 trailing stop. Activate 20 pip trail after TP1 hidden validation. Void if 1H close below 159.90 strategy 3. The aggressor, high risk. This is a counter-trend scalp for those who can lose small and manage risk aggressively. The play is a short at resistance exhaustion. Entry trigger, a 15-minute. Bearish engulfing candle at 160.90. Just below a 3 at 160.95, with the RSI on the 15-minute showing a negative divergence. Stop loss is tight, 161.05, above a 3. That's only a 15 pip risk from 160.90. Target 1 is 160.55, a 35 pip gain, giving a 1 to 2.3 risk reward. Target 2 is 160.30. The pivot, for a 60 pip gain, a 1 to 4 reward. But here's the warning. You are fighting the daily trend, the weekly trend, and the yield differential. This trade has a much lower probability than the long setups. It only works if the intervention ghost appears exactly at that moment or if the overbought momentum finally triggers a fast mean reversion. If the candle rips through 161.05, You are out instantly. Do not move the stop. This is for aggressive traders only. The aggressor, high risk, entry, 160.90, 15M bearish engulfing plus RSI divergence, stop loss, 161.05 take profit 1, 160.55 take profit 2, 160.30 risk, reward, 1:4R to TP2 warning, countertrend, low probability setup and validation, void if 15M close above 161.05 risk management pulse. Never risk more than 1 to 2% of your account per trade. No positions through high impact news. We have US PPI tomorrow, and any BOJ headline can drop at any second. Stops are non-negotiable. This is how you survive to trade the next big move. A string of small losses is tuition. A blown account is a funeral. Keep your size aligned with the volatility. Now let's lock in the close. The single most critical level for the next session is 159.75. If that level breaks on a daily close, the entire bullish structure cracks, and we could see a rapid unwind toward the 50-day MA at 158.85 and possibly further. Until then, the melt-up remains alive, with 160.55 as the immediate door that, when kicked open, exposes 160.95 and 162. Tomorrow's wildcard is the US PPI data. A hot print fuels the yield differential even more, and we could see US dollar to Japanese yen rocket right into the intervention zone. A cold print might give the BOJ a helping hand and trigger the bull trap scenario. Either way, you now have your plan. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live right now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one. The market waits for no one. Trade smart.